I wanted to make a video on bar counting. Bar counting is one of the cornerstones of trading, and other than always in, it's probably, the most important concept. You have to know how to count bars properly, otherwise, you're really going to struggle to figure out trading. The most basic pattern in bar counting would be the low one or the high one. Bar 13 is an example of a low one short. The definition of a low one short is you have a spike or you have a breakout to a new low and then a pullback, and the next bar to trade below the prior bar would be the low one short. So 13 is an example of a low one. We have the breakout here, and then we have the pullback on bar 12, and then 13 is the next bar where the following bar traded below it. So once 14 trades below 13, 13 becomes the low one short. So a low one is essentially the first reversal down after some sort of breakout, which I hope that makes sense. But low ones are at their most reliable in the spike phase of the bear trend. So this is the most bread and butter example I could find of a low one in the spike phase of a bear trend, selling bar 13. So if you were to sell bar 13, it's probably reasonable to just put a stop above 13 because you're betting on a bear trend. If you're taking a low one in a trading range, then it's a little bit different, because if you're trading in trading ranges, it usually makes more sense to use wide stops and to scale in. If you're going to take the sell, again, your premise is that we are now in a bear trend. So you're betting on a spike, a pullback, and then probably some sort of channel down. The market cycle is spike, channel, trading range. So you're expecting, if you sell here, that this is going to be a channel down or a new spike. It's less likely that it will be a new spike. It's more likely it will be some sort of channel, but it's reasonable to sell and just put a stop above 13. So in this video, I'm going to cover low ones, high ones, low twos, high twos, and give a couple of examples of context and the difference between when you should be using, when you can use a wide stop for a trade and when it doesn't make sense to. The key to all of that is going to be your premise, and your premise is determined by context. So again, I know I've said it twice, but I'm going to say it again. Your premise is that this is a bear trend, going to be some sort of bear channel. And so that means you can just put a stop above 13, because if this is a bear channel, we should not trade above bar 13. If we do trade above bar 13, it means we got a couple of bull bars, and your premise is wrong, and this is probably some sort of trading range. And if this is a trading range, then if you sold, you just sold a big bar at the bottom of the trading range. So you don't want to be scaling into that trade, you probably could, but it'd be really difficult to do, to sell, and then you'd end up selling more higher and potentially even higher. If this is a vacuum test in a trading range, it's going to become a much more difficult trade. So it makes a lot more sense to just get out directly above bar 13 in this context. A low two is when the low one fails and you get a second reversal down. So here, bar 33 is the low one short. Why is it the low one short? Because we got a breakout below to a new low of the day. So we got a breakout below bar 27, and 30, 31 closes below 27. So clear breakout here. And then we get the pullback and a low one short on bar 33. This is not a very reliable short. You're selling after a buy climax on 32, and you're selling pretty low in the bear trend. Generally, if you are going to sell a low one, you want to be selling it towards the top of the bear trend when you're expecting the channel or the spike or channel to just mostly be starting, not really be, when you're expecting it to be basically just beginning, you don't want to be selling a low one towards what is probably the end of the bear channel or the bear trend. So you can see we traded back down, and then we got a second pullback to another high, and then we have a low two short. So this is the low one. Then we have the deeper pullback and the low two short on 39. So you can sell below 33, or you probably shouldn't sell below 33. If you did, usually what you're supposed to do is put your stop above the most recent leg, because the low one is not very reliable in this context. This to me looks like a trading range. So if you are going to sell the low one in the trading range, you probably have to have a pretty wide stop, maybe above bar 21. And you're probably thinking, well, it's not really worth selling below here with a stop all the way up here, trying to make a couple of points. And you're right. So that's why it's not really the best idea to sell below bar 33. Bar 39 would be a low two short at the moving average. a low 2 short at the moving average is a really reliable trade. In general, trading trend continuation, low 2's and high 2's is probably your best chance to start to consistently make money. So pullbacks to the moving average with trend pullbacks and with trends high 2's and low 2's are probably what you're going to want to be trading. This was an example. You could look at this as a low. Actually, that's a little too complicated. I'll get into that later. I'm just going to mark this because it was a wedge, 1, 2, 3. But you could also kind of look at it as a low 2. You know what? Actually, I don't need to. I'm trying to make this video as basic as possible. I don't want to get into the because there's this is the most basic of this idea as I can possibly make it. There are a lot more complicated ways to look at it when you're looking at complex legs within trading ranges. And so, you could look at basically bar 56 as a high 2 because we have a leg 1 down. This whole move down, you can consider leg 1, and this is a pullback, and then we have a leg 2. So it's a complex. There's 2 complex legs down, and it's a high 2. Essentially, I suppose it would be bar 50, 55 would be the high 2 because leg 1, pullback, leg 2. But again, this is mostly going to come from your ability to read charts. So the better that you get at understanding the idea and learning to apply it on the chart, the better of a chance you're going to have to be able to understand the nuances within it. And all of this stuff is in Al's course and Al's videos and his books. I'm personally a bigger fan of the books than the course, just because that's how I learned. I read his books, but you're going to have to read the books 3 or 4 times at least to understand them. But once you do, it becomes much easier to read them. They're very dense and they're difficult to read at first, but it gets much easier the more times you read them. So those were examples of low 1's and low 2's in a bear trend. And the low 2 was more towards trading range. But I'm going to give an example of a bad high 1 here. You can see we have 3 pushes up, bar 10, and then a pullback, and then a second push up, and then a pullback, and then a third push up. So it's a wedge, bar 11, bar 15, bar 21. It's a parabolic wedge. It's 3 pushes up. But, you could make an argument, 1920, new breakout. So the first bar to trade above the next bar is probably going to be considered the high 1. So bar 23 would be your high 1. Consecutive bull bars, breakout, and then pullback. 23 is the high 1 for the bulls. However, it's a bear bar. And does this look like a bull trend or more like a leg within a trading range? It looks a lot more like a leg within a trading range. Additionally, the highs of channels are magnets. So we had a spike 24, 25, a pullback, and the channel started on 27. 27 is another example of a low 1 short. And if you sold 27, you could have used a stop above the high of the day, or you could have used a stop directly above 27. But anyways, the tops of channels are magnets, so you know that this is an area where we're probably going to find some resistance. So not very great to be buying up here in general, and really not good to buy the high 1 because remember, high 1's are at their most reliable when they're in. So if you're buying a high 1, you want to be buying after the spike phase of a bull trend. And this is probably just a leg in a trading range and a climactic third push up. So it's also a bear bar, so there's probably going to be sellers above. And there's 3 straight bear bars, 21, 22, 23. You generally do not want to buy after 3 straight bear bars, especially if you're buying above the bear bar. So it's a bad low 1 at the top of a trading range. So there are probably going to be sellers above betting on a second leg down. Why a second leg down? Because of the 3 straight bear bars and because of the wedge. So you do not want to buy above a high 1 high in a trading range. You can take buys on high 1's that are low in a trading range. So I actually think I have an example. Well, you can, I don't know if I do, but if you wanted to buy a high 1, you want to either be buying a high 1 in the spike phase of a bull trend, or you want to buy a high 1 low in a trading range and use a wide stop and probably buy more below said high 1. So probably sellers above this particular high 1. I next wanted to get into a very common pattern on the open, which is the low 2 short on the open. It should be noted that this is a low 2 short on the open. You can see we have the big sell climax down on bar 1. So I'm actually going to ignore what I was about to say, but big sell climax down on with the gap and then a low 1 short on bar 2. So you're thinking, okay, big gap down, that can be looked at as a big bear bar. So maybe if I'm selling below 2, I'm selling below a low 1 in the spike phase of a bear channel or a bear trend. but not really. You're selling way below the moving average, and it's probably a trading range open. It's good to note that 80% of days are going to be trading range opens. So it doesn't really make sense to sell below bar 2 when you don't have a lot of information on the day yet. You need to be pretty sure that you're selling below a low 1 in the spike phase of the bear trend if you are going to be selling a low 1 in that context. And the big gap down, to me, looks more like a trading range open than anything else. So it's really not worth selling below bar 1. If you were to sell below bar 1, you might have to use a wide stop, because in case it is a trading range, you don't know where the top of the trading range is going to be. So if you were to sell here, you'd have to put a stop probably all the way up here. And if you're thinking to yourself, well, I don't really want to sell below this bar trying to make a couple of points when I'm risking, whatever, 40, 50 points. And you're right, you don't. So it's not a very good trade. So the low 1 short is not very good. However, you can see, remember, spike down and then a pullback, and then the first bar to trade below the next bar during bar 3 would be the low 1 short. And then we get a deeper pullback, so a second leg up for the bulls, trading above the low 1, and then we're getting a second reversal down. So it is a low 2. It's also an inside bar. Normally, if you get an inside bar, it's considered a low 1, but this is the context of the bars here is a low 2. Had bar 6 traded below bar 5, then bar 5 would have been the low 2 short. However, traders do not want to sell below a bull bar. So it would be less good if bar 6 got bigger and traded below bar 5. An example of that would be over here. You can see bar 20, low 2 short at the moving average. We traded below, so we get the new low on 13, and then the low 1 short would be 14. You could argue that we went to a new low here, and so this would be a low 1 short. But I think that with the pullback on 18, you could make an argument this is itself a low 1, and this ends up being a low 2. And the way that I look at it is that this is the low 1, bar 14, and this is a complex second leg up, and then this is the low 2 short below 20. Below 19. But most traders don't want to sell below a bull bar, so they'll either wait for a bear bar closing near its low on 20. It's still not as good though, because the bar got too big, and it's no longer the signal bar, it's now the entry bar. So bar 19 is the signal bar, and bar 20 would be the entry bar. So I don't really want to sell below bar 20 as much as I would have if it had been an inside bar. So this is common in trading ranges, by the way, for the market to trade below you're hoping for an inside bar and it just ends up trading below, and it makes the trade a little bit less good. It's very common in trading ranges for the market not to do what you're wanting or expecting it to do. So back to what I was saying, a common pattern on the open is a low 2 short on the open or a high 2 buy on the open. And this is an example of a low 1 and then a pullback and then a low 2 short on the open. What are the odds that bar 6 was the high of the day? I don't know, maybe 40%. It wasn't, we're still really far from the moving average here. So there are certain contexts where it's higher than that. The actual current day that's going on had a high 2 buy on the open. Today's a Fed day, and I don't trade on Fed days, so that's why I'm making a video, and I'm not trading while the market's open. But you can see we had a big gap up, and bar 2 was the high 1 for the bulls. So if you were buying, you probably had to have a really wide stop. So it's really not worth buying above bar 2. And then we got a deeper pullback, bar 3, and a high 2 on the open, bar 4. So you could buy above bar 4, but there's a tail, or you could wait for follow through 5, 6, whatever, by the close. But you can see this was a high 2 on the open and back to the low 2 on the open. Sorry. Here it is. It's a common pattern. So I have a folder full of high 2s and low 2s on the open. I'll just show a couple of examples. Here, bar 6 was the high 2 on the open. And you might be thinking to yourself that it looks like, well, we traded above 1, so that could be the high 1, and then 3 could be the high 2. And so wouldn't this be a high 3? No, because look at the gap. We have a big gap up, and bar 1 is follow through for the bulls. So this is the pullback on bar 2, and that makes bar 3 the high 1 instead of the high 2. And then we have the deeper correction, and then the high 2 on the open, bar 6, and it ends up being the low of the day. I have failed patterns, but just for simplicity, I'm just going to show the times it worked, but I have a folder full of the times this pattern fails too, because everything fails a reasonable amount of time. can see, well, I guess I kind of just contradicted myself, but we trade above bar 2 during bar 3. And you could argue this is a high 2 on the open. Yep, down. This is more context. I'm trying to find cleaner examples. This is a good one. Bear bar, so that's the pullback, and then we trade above it. So high 1, bar 2, deeper pullback, high 2, bar 5. So high 2s and low 2s on the open, high 1, high 2, bar 8. High 2s and low 2s on the open are pretty common. So next, I wanted to give another example with bar 18, a low 1 short on bar 18 on this day. So you can see we have a spike phase, the spike phase of the market cycle, 12 through 15. And then we have a pullback, 16 and 17. It's worth noting that the 18 low does overlap by 1 tick with the bar 4 high, meaning some limit order bulls who bought below the low of the day and scaled in lower were able to make money. So bar 18 is a low 1 short. Do you sell bar 18? Well, yeah, you can. And if you're selling it, you have to think about your premise. What is your premise? Is that we're either going to continue down, it's going to be the spike phase, or a new spike phase, which is what ended up happening. That is less likely than it being a channel. What you're betting that it's not is a trading range. If you did sell below 18 and you accounted for it potentially being a trading range, you would have had to put a stop up here. However, if you're selling below 18 and it is a trading range, it's probably going to be difficult to manage that trade because you just sold a low 1 at the bottom of a trading range, if this is a trading range. So that's why it's a bit difficult here. So if we start to reverse up, it's probably better just to get out directly above 18 and not use the wide stop, because it's going to be a much more difficult trade to manage. And if you sold the bottom of a trading range, it's just generally going to be very, very difficult. So you can just sell below 18 and put a stop above, because if this is going to be a bear channel or some sort of bear trend, like you're saying it is, if you're taking the short, then we're probably not going above bar 18. So that's an example of context determining your premise, because context always relates to your premise, and you use your premise and the context to determine your stop placement. So if you're selling here, it's probably not wrong to put a stop up here. It's just, how confident are you in your ability to scale into this trade and in a profitable way, right? If let's say 10 times, let's say you take this trade 100 times and you put the wide stop. Let's say, I don't know, for example, 20 times it reverses, probably more than this, but 20 times it reverses up and it trades above bar 18. When the market trades above bar 18, and your entry price is here at the 18 low, your stop is up here, and the market trades here. Out of 10 times or 20 times, however many times that happens, how confident are you in your ability to scale in every single time properly and manage the trade exactly correctly? Probably not very confident. It's a pretty difficult thing to do. So that would be why it's more difficult to, it probably makes more sense to just get up directly above 18. So next I want to talk about, where you might want to use a wider stop in a trading range. Bar 64 is an example. Well, it's not, I don't think it's the best example on bar 64, because realistically, if this is going to rally, it should just go straight up. So you definitely don't have to use a wide stop buying above 64. Like on this day, I don't remember if I bought, but if I did buy above 64, I would just put a stop directly below the low of the day, because realistically, we shouldn't get to the low of the day if this is going to be a successful high 2. You can see we traded above bar 60, so we got the bull move, and then the high 1 on bar 60, and then the high 2 on bar 64. So this is a high 2 at the bottom of the trading range. It's a reasonable buy. But what some traders will do is they want higher probability. So they'll use a stop, maybe, I don't know, if your stop would be here, maybe they'll use a stop a little bit more than twice the distance. So they'll have a stop, probably in this area. And they're buying, basically saying, well, if it trades below bar 47, the low of the day, you know that you did a reasonable thing buying above the high 2. So if it trades below, then what they're betting is that they're going to be able to buy more in this area, and that we're going to test back up to the reasonable entry price of 64. Why would we test back up to that price? Because trading ranges often are very forgiving if you're willing to scale into the trade. And they're, if you're using stop orders and not willing to scale in trading ranges, a lot of times they're a lot less forgiving, and it's very difficult to make money. So that's why if you're buying low in trading ranges, a lot of times traders will use a wide stop and just bet that the market's going to stay in a trading range. If we do trade below, it's still not smart to sell on a stop below the bar 47 low and bet on a giant breakout. It's probably a lot better to wait and see the follow through. And so if the bears do get some downside follow through, then these bulls who are buying with the wide stop will exit. They're probably not going to let this stop get hit very often. If you're buying here and you're adding on here, you're trying to make a profit on your scale and buy. So you're probably not going to let this wider stop get hit very often. If this is a confusing part of the video talking about wide stops, then probably better not to use them. In general, it's better to just wait for the best 1 or 2 swing trades every day and not really use wide stops. That's something you should do after you've been trading, consistently profitably for a year or two. So anyways, if you buy here and you use a wide stop, you're increasing your probability on this high too. So you buy, you scale in lower, and you're hoping we're going to get back to this area. Obviously, it did not happen here. That's not what ended up happening. But that is an example of a time where you would use a wide stop if you're selling some sort of low two. You can see here, this is another example of a low two. We have the new bear move to the bar 24 low, and then we get a rally. And once we trade above the prior bar, so once 28 trades above 27, you are now looking for the next bar to trade below the prior bar in order for that to be considered the low one. So 30 is the bear bar closing near its low. And when we trade below 31 is the bear bar closing near its low. And when we trade below 31, that is now the low one short. You can see we trade above it on 32, an outside bar, and then another bear bar closing near its low on 34. So this is a low one, a pullback, and then a low two here. So 34 would be the low two short. Again, this is the most literal definition of this concept. You can apply it in different ways. Like, this is going to be a bit of a more complicated example, but it relates back to your chart reading abilities that are really important to develop. And like I said, watching this video on high twos and low twos is not, or high ones, low ones, high twos, low twos is not nearly enough. You need to go read the books a bunch of times. You need to go watch the videos a bunch of times until you can comfortably go through every single bar on this chart and know exactly what's happening at all times, and where you can pick out every single high one, low one, and every single high two and low two on every single chart that you look at without really thinking about it. So this is an example of using context, where this whole move up 27 to 35 is a leg one. And if you're new to the concept of low ones and low twos, you can just ignore this piece because it takes a while to get good enough at reading charts to put this sort of thing into practice. But this is a leg one up. It's a complex first leg, and we get a pullback, a two-legged pullback, and then a climactic second leg up. So we now have 2 legs up. So it's reasonable to consider bar 45 a low two short. This is the low one. Probably bar 35 would be considered the low one, and then bar 45 would be the low two. So you can apply it to bigger legs. It's not a rigid concept. You have to end up learning how to be more fluid with it. But this is a low one short, and this is a low two short. And yeah, you can make the argument that the low one, I suppose, would be, this is a bad example of what the other thing I was about to say, but yeah, this would be a big low two short, because that's what the context is. When you get a big leg one and a big leg two, it's still a low two short. The same way that this over here, down and then a high 1 by 12 pullback, and then technically, you could argue that 24 is a big high two. It's probably better to look at it as a truncated wedge, 1, 12, 24. But still, you could still make that argument that that's the high two. I think I had 1 or 2 more concepts. This is going to be a pretty short video, I suppose, but I believe I had 1 or 2 more areas. Well, first off, inside bars are considered high ones or low ones, depending on if it's bullish or bearish. So in this area, do I have anything past? Oops, sorry. 1 second. Okay, yeah, I got to go over this. But after these 2 concepts, that's pretty much it. So an inside bar is always a high one or a low one short. You can see bar 36, it's a bull bar, so no one really wants to sell below it. But we do have the spike on 35, and this is the pullback, and then the next bar to trade below. So it is on some time frame. You can see we have the spike down, and then a pullback on 36, and then when we trade below 36, it's the low one short triggering. So inside bars are low one shorts. So you could look at bar bar 9 as a bull breakout, and then bar 10 as the pullback. So breakout and then pullback, and then bar 11 would be the high 1 inside bar for the bulls. If we traded above bar 10 during bar 11, it would not be as good, because then bar 10 would be the high 1 for the bulls. Now, it doesn't necessarily have to be, again, as rigid as it has to trade below, and then you can consider it the low 1, because obviously after the breakout bar 9, we didn't trade below any bars. However, this is a pullback. Bar 10 is still a pullback. So if you still think about it from the concept of it's a breakout and then a pullback, and then the next signal is the one that you're talking about, it gets a little bit easier to think about. And again, it takes a lot of time to really apply the concept, but I was thinking about this morning, actually, when I was making this video, if this makes any sense to anyone. Outside patterns are kind of technically high 2's. I don't remember this being said anywhere else. I'm sure it was mentioned by Al at some point, but I probably just forgot. But if you think about it, we have bar 30, and then we trade above bar 30. So bar 30 is an inside bar, right? So we trade above bar 30, triggering the high 1, and then we pull back below it, and then we trade back above that bar. So we trade above, and then a pullback, and then back above, which is the same concept as a high 2. So you can see below, pull back, and then back down. And here we go, above, pull back, and then back up. So an outside pattern is kind of just a way, it's a breakout mode pattern, but it's kind of just a way of thinking of a high 2. It's also it's an expanding triangle. So inside bars are triangles on lower time frames, and outside bars are expanding triangles on higher time frames. Sorry, consecutive outside bars is just an expanding triangle on a lower time frame, is what I meant to say. You can see 30, 31, 32 getting the higher highs, and 30, 31, 32 lows getting the lower lows. So it's just this, which is what an expanding triangle is on the higher time frame. And we had expanding triangles recently. I'll just go over that real quick. No, we had one pretty recently. I suppose the lows, not the most clear-cut example. I can actually just do this. For like the best example I have, I think this one's a good example, probably. Yeah, so low, high, low, high. I mean, the low ended up being later, but yeah, here the high and the low, and the high and the low. So these aren't. This isn't the point of the video. I got sidetracked. So, anyways, back to what I think is my last example. So low 1's and low 2, or low 1's obviously are not always reliable. It depends on the context. Here we have the big bear breakout, or we have the bear breakout, and ends up being the sell climax in a vacuum test. And some bears would make an argument that this is a pullback of this, and so this is their low 1 short on bar 14. The context is terrible for the bears here to be selling below bar 14, but the way the bulls look at it is it's the first pullback for the bulls. So when we go outside up above bar 14 is now a high 1 for the bulls, and 15 closes on its high. So you have follow through for the high 1 when you get bar 15. So it's reasonable to buy above bar 15, thinking we have the spike, and this is the pullback, and outside up trigger the high 1, bull bar closing on its high. We might get some sort of channel up. In this context, it's okay to wait for the breakout above the bar 1 high, and we have consecutive bull bars. But you can see how technically for the bears, they were arguing this was a low 1 short. So again, I can see how you would think it's towards the top of the trading range, right? So you're thinking 14 low 1 towards the top of the trading range, but the context is really bad for the bears here. This is a terrible sell. Better to buy below the bar after this many straight good-looking bull bars. And we're oversold. The prior day was a bear trend day from the open. When you get a bear trend from the open, 75% chance the next hour is going to have 2 hours of sideways to up trading starting by the end of the second hour. So that set alone makes this bad. But you can see when we get the outside up, basically it triggers the high 1 buy for the bulls. So I might start doing some sort of basics video, and this video is definitely a little bit choppy, so I'm going to work on that in the future if I keep making these for this particular series. But that was just basically my most basic explanation of high 1's and high 2's and low 1's and low 2's. And yeah, so that's it.